This is paying off debt. This is 107. This is our seventh one. Yeah, 107. And we're going to talk, no, 106, sorry, 106. We're paying again, and should you do it? And we're going to talk about reasons you might and how you might, among a few other things. So we're going to discuss these four things today. How to pay off debt. Got a couple different ways to do that. One that we prefer, one that people use and actually makes sense in certain circumstances, but actually ends up costing more in the long run. Still not a bad idea, but we're going to talk about both ways. We're going to talk about credit cards. We're going to talk about borrowing to buy a car versus leasing a car. And we're going to recommend doing neither and using cash and buying a cheaper car. And then we're going to recommend or talk about how to qualify for a loan. John, I think you're going to launch us, right?
Yep. So here is our first section, how to pay off debt. And on the next slide, this is a big overview of recommended debt payoff method. We will get into more details, but they say sometimes if you don't make a list, if you don't make a plan, nothing happens. So list the debts that you have. Get out a piece of paper or put it on a spreadsheet and list the debts that you have out there. Contact creditors to see if you can get a better rate, or maybe there's on a credit card, maybe there's some kind of special promotion that you don't know about. I called up my bank, Wells Fargo. I got a credit card with them where when I use it and I pay it off, I get points towards, I get cash towards my mortgage. So I can make extra payments, believe it or not, by using the credit card. And then finally, pay off your debts that have the highest interest rates first. Pay them down first. And then on our next slide, causes of out of control debt. Now here's a question. It'd be great if you use the chat box function. Which of these can we control? Which of these, do we have the power to control? Okay, here's one. All of them. Okay. Anybody else? All. Wow. Okay. Lifestyle. Gambling might be tough. Oh, gambling is easy to control? Sometimes for some people, gambling is an addiction. That might be really hard to control. Well, those are great answers. For me, I would say lifestyle. Fantasy sports is not gambling. Okay. So for me, it'd be lifestyle. And yeah, I don't gamble. But anyway, those are some of the root causes of out of control debt right there.
With the debt avalanche, I mean, does anyone here just pop into the chat if you've heard of the debt avalanche or the snowball payoff method? We're going to go over both of them in relative detail. It doesn't take long to go through either one of them, but just let me know if you know what these are, or if you haven't heard of either one, just say so. Okay, so we got a thumbs up from one. Okay, good. There we go. Yep. Which one does Dave Ramsey recommend? I think he recommends Avalanche. I think most people recommend Avalanche. No. Okay. Okay. We'll go over them both. So the debt avalanche works kind of like this. So you pay off your debts in order. So you start off by listing them, like John said earlier, and you start with that highest interest rate one first. And by doing it this way, by starting with the highest interest rate, and then once that's paid off, going to the next highest, and when that's paid off, going to the next highest, that's the way you actually pay the least amount of interest until everything is paid off. Okay, so has anybody used this method? Okay, we got someone that did. That's good. So those of you who did use this, I saw a couple yeses. Never got overwhelmed. That's excellent. For those of you who have used this method or focused on the highest, what were the biggest challenges? We work with people, when I've worked with people in the past on paying off debt, there's always one challenge that comes up. just wondering if you guys have ever experienced that challenge. And this is why the debt snowball often works. The next one. No one. So that the challenge I hear about is people feel if somebody has, 4 or 5 different debts and there's a big one that's got high interest, it's really difficult to feel like you're getting ahead if you're paying off just the highest interest one and that's all you're doing. So sometimes to manage that sense of, oh, I'm not getting anywhere, people recommend the debt snowball, because in this method, what you do is you do the same thing. You list them in order, but you pay them off in a different order. You don't pay them off based on rate. You pay them off based on size. And then when you say you have all the debts are lined up, you have $1,000 total payment, you pay them off based on size. When you pay them off, you continue paying the same minimum payment. So the payment you used to use on the other one, on the first one that you pay off, you then commit to the other debts. And by doing that, you pay more interest long-term, but you feel like you're getting ahead. So it can be a nice stimulant to help people keep moving forward on the plan when it doesn't feel like you're really doing what you should be doing. So by following the snowball method, you might spend a little bit more on interest, but you feel good. And going from 6 debts outstanding to 5 debts outstanding to 4 debts outstanding can feel pretty good out of the gate. And it makes it simpler to attack these bigger debts as you're moving towards it, which is great. Both of these processes are pretty simple, right? But I actually prefer the Avalanche. And there's still times to make Snowball make sense, but I prefer the Avalanche. I had a client once who had a single, very large, high interest debt. And when they were paying this off, they just never felt like they were getting there. So it's always good to have that good sense of getting ahead as well. Sort of trick yourself into continue moving down the path.
Okay, so here are the other methods of debt payoff. Balance transfers. Has anyone ever done a balance transfer? That's where a credit card, there may be a 1 year with no interest. My wife did that years ago. I think it was probably in the mid 90s. She was just starting off in real estate. She was spending a lot of money, buying supplies, doing this, doing that. And she had a yes to balance transfer. Good. Anyway, it worked. It worked great. She got a credit card, no interest for a year, and she paid that down in a year, and she's never been in credit card debt again. Personal loans, that's maybe like one debt to another. Debt consolidation services. Has anyone ever used a debt consolidation service?
We've recommended it to people. I've never, I don't know if, yep, exactly. Student loan consolidation, that happens a lot.
Yeah. Now here's debt settlement. Now debt settlement is kind of like a private negotiation between you and the creditor, and you approach them and say, hey, can you help me out with this? And then finally, there's bankruptcy. That would be Chapter 7 bankruptcy, and that's going to be going through the courts. And then the general public may be aware of what you're going through, because that's going to be public information.
So, John, one of the things that, so many people I've worked with in the past, they get to the point, if the debt becomes overwhelming, multiple credit cards, student loans and credit cards, personal loans, credit cards, student loans, everything mixed together. A lot of people start to hide from the creditors, and that is never helpful. I had a really close friend of mine who was doing this, and I said, this was during 2008, so this was during the Great Recession, where banks were all being cruel to begin with, but they were also willing to negotiate if you were communicating with them. Yeah. And he had a first mortgage, and he had a line of credit on his house, and this was, I believe, Wells Fargo, but I've heard stories from almost every bank doing it, when things are sketchy and when you are actually in a lot of trouble financially, banks see this. They will work it out. They ideally will want to put some interest on the back end. But sometimes they'll say, you know what, we're never going to collect on this, and they'll write it off. And then for this particular gentleman, they wrote off the second, and they reduced the interest rate on the first. This was the worst financial crisis we've seen in my career. So they totally wrote off a second, reduced the interest rate on the first for like 10 years, and they allowed like 1 year of payments to be deferred. So his payments went from overwhelming to zero for a year. It was obviously tremendously helpful for him to dig out from a pretty big hole. But these are the kinds of stories that only exist if you take the time to call the creditor and say, hey, listen, I'm in a lot of trouble here. And they get it. And they know that if you go through bankruptcy, they will get nothing. So having that negotiation when you're actually really at the end of your rope makes a lot of sense. I hope you never get there, but if it happens, there are ways to deal.
So again, just to sum up, create your own debt payoff plan. Again, start with the list, put it down on paper, look at it, and then choose your strategy. I mean, I kind of like the Avalanche strategy. If I were in that position, I think that's where I would go. That's the plan I would use. And then select the debt which you're going to pay off first. Again, the one with the highest interest rate makes sense. See if you can make some extra payments along the way if you can. And then what's left. And just keep working the plan. Knock them down, one at a time. And then get out from under that and hopefully never go back. I have a little personal story. Again, going back a long time. I think I was in my early 30s. I had about $5,000 of credit card debt, and my grandmother passed away, and I got a little inheritance of about $5,000. So for a minute there, I was like, "Wow, this is a great windfall. I'm going to have some fun." But I used the money to pay off my credit card debt, and then that was it. I've never been there again. And anyway,
one of the keys that we always have to talk about when someone's in debt is just patience with yourself.
Yeah,
you got here, you can get out. It just takes time. Right. All right, we're gonna talk about some credit cards here. So use wisely. These are great tools. They simplify managing financial lives. Use unwisely, they're the beginning of financial disaster. I think there's, I remember freshman year of college going to my dorm room the first time. I tell the story all the time, so probably someone's heard this before, but I remember going into my dorm room, and then, there's the closet, and there's a mirror in the middle, and on the shelf underneath the mirror, there was 2 little boxes for the 2 people that were gonna eventually populate this dorm room. Open up my box, there's 5 credit card applications. So this is coming out of high school, first year of college. So the problem with credit cards isn't actually the cards. It's the combination of that culture and our total lack of financial education on how best to use them. So can anyone guess what I mean when I say we have a culture problem around credit cards? Pop that in the chat. What does that mean to have a cultural problem around credit cards? Consumption culture. Yep. Spending is fun. They don't talk about debt. That's good. Yeah, Kimberly, that's fantastic. The idea of instant gratification, you guys know the marshmallow test. It's been debunked a little bit recently, but I think the idea is sound. Is we have a very, very difficult time postponing gratification and knowing the difference between wants and needs. Yeah, and I think today more than ever, because we have this thing called Amazon, and I can get anything I want delivered to my door in like 2 hours. Yeah, there's some things I can't get in 2 hours. I got to wait a day. But that whole thing is not good. And then social media, where we look and see all the things everyone else has that we don't have, and this idea of we deserve it or I want it, it kind of takes over. So it become that culture of consumption is kind of problematic, and just be aware of that. You don't need it, but you might want it, and recognizing that difference is pretty important. Because we can hear when you're talking. So the basics of credit cards are the tools. They represent revolving loans. They allow you to borrow, to buy on demand up to kind of a limit. They can enable very simple expense management as long as they're paid off every month. So you definitely want to be aware of the terms that you sign up for. But the most important item is obviously that interest rate, because even though, interest rates on savings are down, the interest rates on credit card debt has stayed pretty high. It doesn't respond the same way to rate changes as we would hope, given what's going on in the market economy. Credit card interest rate stays very, very high. In fact, in some cases it goes higher if there's a risk involved and you're not paying. So you just want to be aware of those terms. These are the basics. John's going to get some more specifics here.
I've got a story for just about every slide here. Unique features of credit cards: greater protection if lost or stolen. True. But there's something else. We knew somebody, I'm not going to name any names, but I think Jonathan may remember who she is. She used her debit card at Whole Foods to buy a load of groceries, and it may have been holiday time actually. They somehow charged her debit card like 2 times. They just doubled it. And she had to fight with them for quite a while to get that overcharge back into her bank account. That's not going to happen with a credit card. So not only do you get the protection, if lost or stolen, but if there is some kind of a issue with a merchant, you're better protected because the money doesn't leave your bank account right away. Obviously safer than carrying cash, and use as a tool to improve your credit rating. One of my kids, she's 23 years old. She ran by a bunch of different credit cards. Which one should I get? I helped her pick out the one to get and gave her some rules of the road. And she's just going to use it as, 23 years old to start establishing her credit rating. The best way to manage a credit card: be the credit card company's worst customer. What do you think that means? Pay it off every month. Bingo, low usage. Or pay it on the last day, pay off every month so you don't carry a balance. That's exactly right. And then we just talked about this: make the purchases and pay them off. Get a card that offers special bonuses, like the card I got from Wells Fargo. I charge on it, pay it off, but I get cash towards my mortgage principal. I mean, it's not a lot, but it makes me feel good. What else we got? Pay it so you have no interest. Max it out and move to New Zealand. Okay.
No, voila.
All right, let's talk about how people get into credit card trouble. They make the minimum payment only. Yeah, I mean, in our financial planning software, we can put in a credit card and the interest rate, and yeah, you'll be 95 years old and you'll finally pay it off if you make the minimum payment. Or probably you won't. You will never pay it off. Carry balances month to month. Don't understand the terms and conditions. Yeah, forget when a promotional interest rate will expire. Don't understand the concept of compounding interest. Yeah, that compounding interest, that leads back to making the minimum payment only. Because if you're just making the minimum payment only, you're not making any traction on the principal balance on that.
There's a common misperception. We run into this all the time that, oh, this is the minimum payment. I can just make this and it's all going to be fine. That is all you have to make. But the credit card company is not setting the minimum for your benefit, right? They're setting the minimum for their benefit. And like John just said, if all you do is you make that minimum payment, you're just covering the interest. And if you spend a little bit of principal more, or if you, do something else with a different credit card, or you end up just getting further and further and further behind. So it's best to pay way more, pay it off every month, but there's some people that can't. So if you can't, you pay as much as you can, definitely more than that minimum payment. So the idea is, I imagine that you sort of come summer 2021, we're going to see that many people survive this pandemic by borrowing. And right now, those stories of anxiety are going to be stories of debt. If you look forward, 6-8 months. Actually, in some cases, it's already there. I've talked to people that it's already happening. So the survival of an income shock always leads to a balance sheet shock. The only way to survive this is to use debt for many, many people. There's lots of jobs that aren't there. The only thing they can do is they can rely on credit cards to make payments on things. So when we come out the other side, the idea is we have to come up with all kinds of ways to create more income so we can pay off the debt and live our lives and not incur more debt. It's difficult to do this. We know all the stories. We read the media on this pretty much every single day. I have run into this problem myself, and I have worked with lots of people going through it. It's hard to do. We're gonna see this more and more and more in the next 6 months. It's going to be top of mind. I hope no one here has the issue. If you have a major challenge, I hope that you'll reach out to somebody and start working through this and getting some help on it. The more you can reduce expense and keep this debt to a minimum, the better 2 years from now will be for you. So, all right, there's lots of variables on automobile financing, loans, leasing. We're going to start introducing the various types of loans and lease options. We're going to understand what lenders look for to qualify you for a car loan, and how you weigh the options when they're presented to you. So how many of you currently have a car loan? And then, as a second question, how many of you have never borrowed for a car? Has anyone never borrowed for a car? Be more clear. I've asked 2 questions that the answer could be yes for 2 different ways. Paid it off 3 years ago. Excellent. That's great. No car loan, no car loan. I've purchased cars in all the different ways you can imagine. Leases, borrowed when I was a kid. I built my credit with a car loan. If you can buy a car for cash, it's great. I think that's what John just said. If you're going to borrow, then choosing the right program can save you hundreds or thousands of dollars over the lifetime of the loan. There are lots of variables. Obviously, there's the car price is going to drive most of these variables and most of the savings. So picking a car you can afford is the most important part of this decision, especially today because rates are so incredibly low. So things like loan terms, though, I've seen car loans from 1 year to 8 years. If you have an 8-year loan, you're going to end up paying a lot of interest on the car. And sometimes people say, for me to get the car I want, I'm going to accept an 8-year loan because that'll keep my payment low and affordable. But then you end up paying twice for the car because you're paying all the interest to go along with the actual price of the car itself. The rate is important, and that's determined by your credit score and some of your debt ratios.
Okay, the auto buying process. Now let's be real here, okay? Real world. This is the process from left to right. I don't know about you, but I go right to left. You see a car, that's the car you want, right? That's how I've bought my cars. Does anyone do it the other way around, the textbook way?
Sure. I mean, I've done that where you've you go, how much can I afford? I'm only going to look at the cars on the list less than $5,000.
Oh, okay. So when I bought my first car, my first new car in 1982, it was a car I wanted. I signed all the papers. They were going to run the loan and whatnot. Got a pretty good rate in the 80s. It was like, I can't remember what it was, 12% interest, 13% interest. then the salesman calls me back and says, John, I can't get you that loan. You haven't been working long enough. Your income's not high, blah, whatever it was. Well, can I still get the car? Yeah, I'll run it through another bank. Okay, great. Well, that interest rate was 17%, but I got the car I wanted. And I could afford to make the payments. But the right way to do it is really to do it more rationally and decide, on your loan term, go with the lowest interest rate you can, get a pre-approval, and buy what you can afford. I guess that's what it really is. Buy what you can afford. Me, I did it the other way, and it worked out. But that's a real life story for you.
That's an important thing is there's rules of thumb, there's ways to do it the right way, and you can totally screw up and then repair and protect and take care of yourself afterwards. You can always fix problems that you create for yourself. Okay. Pitfalls of winding up upside down. So, upside down, when I think of that, I think of the housing crisis, but that can be with anything. When you borrow money to buy something, and then what you owe is greater than the car's value, and that's negative equity, and that can happen in any kind of transaction like that. So how to avoid that? By taking out a shorter term loan. The longest car loan I've ever seen is 5 years. Are there ones? Does anyone know? Are there longer loans out there? Yep. I've seen 7. I've heard of 8. Wow. Yeah. That's how they get. All right. And then the next slide. So you've got a car where you have a loan remaining, you've paid down 7313, you still owe 12687. You're going to trade it in. They're going to give you $9,000. Oh yeah. You still owe 3687 after that, right? So you have a new car, you still owe on the loan that you had prior, even though you don't own the car anymore. And so that's what it means to be upside down. It's not worth the value of the trade-in. I might be mistaken, but I think this could even happen if you're in an automobile accident and your car gets totaled. Yep, sure. And the insurance company will settle and you'll get a check, but you still owe on the car. That's got to be a horrible feeling. Yeah, no good. And last slide on this. Beware of the repo man. What happens if you can't make your loan payments? They come and take your car away. Your credit history is severely damaged, is true. Those are fun programs to watch, though. Yeah. Has anyone ever had their car repossessed? And would you admit it in a public? Would you admit it? Like when I was younger, the cars I purchased were like $1,200. That's on your bucket list. It's on his bucket list. Well done, Koala. Yes. I'll tell you, I've had my car broken into several times, and that's a horrible feeling. Repo man's got to be worse. Totally. So one of the big costs of a car is insurance, and obviously, right? If you buy used and pay cash, you get away with not needing as much insurance and not as much insurance being required. If you buy new and borrow, insurance is going to be a lot more expensive, hundreds a month more expensive, because lenders are going to require full coverage, liability, collision, comprehensive. So you should always shop around, obviously, to get the best deal on insurance. But the first decision on whether you buy new or buy used and whether you get a loan or pay cash is going to be the determining factor on how much that insurance is going to cost. Folks here all own, or does anyone lease? I'm going to know who I'm going to be ripping on for the next couple minutes. I apologize ahead of time. I've done it too. Own, 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 own. Oh, good. You guys are making me so happy. I'm just going to wait for one lease and then we're going to go forward. No? Okay, good. That's fantastic. So there's, oh, even better. So there's nothing wrong with either of these two options, really. I would suggest that if cars are not your thing, that buying and holding, just like an investment, buying and holding a car is a better choice. I'm gonna just, John, how long have you owned your car, your main driver?
Oh, I'm gonna have to get out a calculator. Let's see.
You didn't buy that
26
new.
years.
How many?
26 years.
Did you buy that new?
Yeah. And
Oh
I
my
did take a
God.
loan out on that.
Yeah. Okay. So what is it? It's a 19 what Honda?
1994 Honda Civic. Yeah, hatchback.
Hatchback. Yeah.
Yeah. Been broken into like 3 times, been stolen twice. I mean, it's one of the most valuable automobiles in the world. People just want it.
So if you are a car person, then that's one reason you might want to lease, right? Because then you get a variety of driving experience. You get to upgrade your car every now and then, and that's one of the reasons to do it. But it's not a skillful use of money if you're just like about cars to use a lease option. So for most people, a lease is going to end up costing you a lot more money. Still, the one category where it might make sense is a business owner. Outside of if it's your thing. A business owner might be able to write off all the lease payments. They may not be able to write off the pay down of a loan. So because of that, leasing a car might make sense for somebody that can write it off. But even then, even if you are a business owner, unless you're in the highest tax bracket, it still may not make sense, to lease. I still see a lot of people do it on a regular basis. It's not necessarily a good financial decision. So the best thing to do is to buy a car. If you have to use a loan, pay it off, and then hold the car for a long time. That's how you maximize the value out of the car and enable savings for the other things you want in life. But this is really old thinking. It's kind of my parents talking here. So I'm glad everyone's agreeing with me on this. I feel like I came from a good place. I remember when I moved to California from South Dakota, everyone always had new cars. And I was like, I don't understand this, because my parents always purchased 10-year-old cars. And then as the saying goes, they drove them into the ground. We'd have just like it's driving into the ground. Exactly. Right. And then I inherited a 25-year-old car when they were done with theirs. Exactly. That's how it worked in my house, Koala. And then if the car that they're purchasing had less than 150,000 miles on it, my parents said it wasn't even broken in yet. Like they would buy cars at 180, 100, 200,000 miles on them and drive them into the ground. I would, today we look at that and say it's already in the ground. Like at 200,000 miles, it's already done, which is, not good for our landfills and all those kinds of things. So it took me about 15 years living in the Bay Area before I bought my first car. And I sort of got caught up in it. And I ended up buying one new. I also ended up leasing one. And I never really saw, at least a couple actually, and I never really saw the waste until, I really started working with clients and started doing the math on planning. And then I was like, you know what, this doesn't make any sense. Why would I do this? I could write them off, but it wasn't really worth it. I didn't make enough money to justify it. So if you do a lease, then at the end of your rental term, which is what it is, it's just a long-term rental, you've got the option to buy or to start a new lease. So buying after the end of a lease is almost always the most expensive way to go. In terms of monthly payments, though, it feels good because your payments are low for that initial 2-3 years of the lease period.
Okay, now we're going to talk about buying a house, a home. So the FHA loan, you can see the features on here. Good for first-time home buyers, backed by the Fed, relatively low credit score, and some restrictions on them. Why do you think an FHA loan is good for a first-time home buyer? The reason is that there's not, you don't have to put down a lot of money on an FHA loan. In our neck of the woods, here in Berkeley, Albany, Oakland, we're in a very competitive real estate market. Sometimes when an offer comes through with an FHA loan, because not much money has to go down, that may not, you may get bypassed, meaning the seller may want to sell to someone else that doesn't have an FHA loan, maybe more of a conventional loan. They're putting more money down, and the seller may feel better about that.
So there are two important ratios to keep in mind in this space. The first is this, what we see on the left here, which is the housing expense to income, and the other one is debt to income. We're going to look at them both in more detail, so I'm going to pop into the next thing here. So the housing expense to income ratio looks at this data. It looks at the total cost of housing. That's PITI, principal, interest, taxes, insurance, and then dues if you've got homeowners insurance. It doesn't include things like maintenance, repairs, utilities, and the lower the number, the better. So if you know these off the top of your head, write them down real quick, and we'll do a little bit of math, and we'll talk about your housing expense to income ratio. This is kind of how this math works. So in this example, we have someone that's got $1,200, so not in the Bay Area, of total housing expenses divided by $4,000 of income, okay? So their ratio is 0.3, right? That's an okay ratio. Once you get up over 0.35, it gets to be a problem. So going into this, I actually thought that mine would be pretty good, but I looked, for some reason, property taxes, I wasn't including those in there. And so when I looked at my property taxes, and I purchased my house in 2007, property taxes really pushed it up, and I was just above 0.31, but I'm in the process of refinancing. And when that refinance is complete, I'm going to be just under 0.3. So anyone do their math real quick in their head, or anyone want to share their ratio? I want to see if anyone's below 0.25. It's pretty amazing when you see someone below 0.25. They have managed their finances pretty well in terms of their purchase choice of their house. Just like we talked earlier about the kind of car you buy, it's important, and we see this a lot when working with clients. It's important to not overbuy house. And I remember when I just entered the housing market, they told me, buy a little bit more than you can afford. And I think the person that told me that was the realtor. I don't know why that would be. So we've actually had to tell clients that, sorry, you can't stay in the house. And that's pretty rough. You can't afford this. That's not a fun conversation to have. Okay,
debt to income ratio. Yeah, we kind of touched on this a little bit. So there's all your sources of income. These are your obligated debt, and then non-obligated, are things that what we call like your everyday living expenses, like groceries, utilities, getting haircuts, going to restaurants, entertainment, things like that. So that these make up that. And then debt service, again, the lower your, like Jonathan had on the other slide, where Koala was at 0.28, the lower your ratio, the better. Monthly debt expenses over monthly gross income.
So there's lots of different sources for credit score. Your credit score is going to dictate the loan process you have to go through, whether you can get pre-qualified, the kind of lenders you get to work with, the interest rate you're going to have to pay. The credit score is the key to securing the loan. So, you can look it up once a year, free. And actually, you can get it more often than that, free. But you should look at it at least once a year, free, and repair it if there's anything that stands out as problematic. I'm looking at, there's 5 different sources. I think about Experian as the one that many people look at. So does anyone have an 850 credit score? The total scores go from 300 to 850. And some of them are a little bit different than that, but that's the long-standing ones. Does anyone have an 850? Or anyone ever seen an 850? I'm just curious. So I haven't seen my score for a long time, but I remember when we refinanced our house. I'm gonna prove you wrong. So when we refinanced the house, I don't know why, but my wife and I each had separate credit ratings for some reason, and hers was 850. So I was like, wow, I felt like I had to bow. That's like, I've never seen that before. It was just amazing. So again, your credit score is going to determine whether you have to put down 20% or 10% or 3.5%. It's going to determine the rate of interest you got to pay. It's going to determine the types of lenders you can work with. So we talked about this before, but it's worth mentioning again that if you can check that credit score once a year, you should do it, and you should repair it if there's anything that's a mistake or anything you've paid off and you're not getting credit for. You should definitely write letters and make sure that this stuff gets reflected.
Now we're getting close to buying a house. So we're looking around. You're going to find a real estate agent. Around here, at least, the first thing they're going to say to you after some pleasantries is, are you pre-approved? So when you're looking for a house, you want to be pre-approved, meaning you want to get a lender, you want to get a letter from a mortgage broker or a lender saying that, yeah, you know, you're pre-approved for this price range. And they'll ask for some information. And they can use if you get this information to them all at once, within 24 hours, they can usually get you pre-approved. But they're the things that you need. And if you really want an agent to show you around, you want to be pre-approved. Shopping around for the best lender. You know, banks sometimes are not at least in this market where things happen fast, banks may not be the best place to go. So you may want to work with a mortgage broker. But there are some mortgage brokers that just, you know, work through one mortgage bank. There are other mortgage brokers that can shop multiple lenders. So if you can find a mortgage broker that can shop around for you, that is a great way to go.
And it used to be that a mortgage broker could have special deals with different lenders, and they, after 2008, they cleaned that up. So a mortgage broker may have a different price. They may charge more or less, but other than that, the deals are the same. There's no more shenanigans in that space.
Okay. And here we are comparing loans. I talked a little bit about this at the beginning when I hijacked Jonathan's slide. FHA loans, easy to obtain, government-backed, low down payments. Again, smaller down payments in a competitive market. You may not get your offer accepted due to the small down payment, and that makes the seller kind of nervous. Like, is this really going to go through? So there's your conventional mortgage, typically 20% down or more, good credit score, low debt to income ratio, VA loans, and then, you know, Freddie Mae and Fannie Mae and Freddie Mac.
So this is a really important thing. I just want to real quick, you pop this in the chat if you want. Has anyone found a mistake at closing when they purchased their house? And I ask because the last time we did a refi, which was the same time, you know, Kate ended up with an 850 score, far superior to mine. But during our last refi, there was a 0.1% increase in the rate after, you know, when they came to sign here. And we did this at night. We had a notary come to the house with the documents for us to sign. And so the bank wasn't open, and it came to us and it was 0.1% higher. And so we had to reschedule the whole thing. And I just simply said, I'm not gonna sign this. There's just no way.
Yeah.
So it's really, really, really important to read the documents. I know that when you're buying a house and you have the mortgage and it's all done the first time, you've got 500 things to sign. And there's a tendency for the people that are with you to just move along, move along, move along, move along. Read the fine print.
We did a refi, years ago, and we're there in the office. I'm going through the things, initialing, and they had my social security number wrong.
That might have been an advantage. You might want to sign that one. Let them come after you. I don't know who that guy is. I think that if you really looked at it, if we just said, okay, let's look at all the mistakes, I imagine that those mistakes would tilt in favor of the bank. And if you just think, how many of those got by and people didn't catch it and the bank makes extra money on it versus people, catch it and the bank goes, oh, our bad, right? So it's a discrete thing. They could do this intentionally at some, percentage of mistakes, and that would be acceptable. And I wouldn't put it past them. That's probably too cynical. It's probably more cynical than I should be, but it's, it was an affront when I was like, really? After all that conversation, it's 0.1% more on paper. Like they were like daring me to do it. Just, ugh. So final loan approval. By this time, your mortgage broker has likely collected all the stuff that's necessary. You see here in additional documentation, and more than likely, the credit check has been run. But they do run a final check once they have everything and once you sign things. And this is when it becomes real. And it's not a loan until the funds transfer, right? That's when you know that things are gonna close. If you've heard that phrasing before. And this is all the stuff that the big list of items that might be required through the whole process. You got to prove, that you can pay them back. You got to prove you have assets. You got to prove that that you have an income stream. You've got to prove that you have a history. You've got to prove that everything you've talked about in this whole process is for real. And by proving it, they say, okay, here's your $800,000 for your house.
Okay, and how do they evaluate you? Character, your credit score, and payment history. But if you're buying a house with another person, two people, and you're both going to be on the loan, they're going to go with the lower credit score. So, like if I'm 850, my partner is 750, they're going to go with that. So, you want to have a good partner in this transaction. Just kidding. Capacity, the ability to pay off the loan. You see what Koala said?
Yeah, I did. I saw. I still.
Capital, the amount you have upfront for a down payment, and not only for the lender, but for the seller. The agent is going to present your offer to the seller, and if you have a lower down payment, you may not even get this far anyway. Assets, the collateral you have to secure the loan, and the terms of your loan.
Final tips, John. Final
tips.
Last active slide. Last presentation slide.
Yeah, be careful who you borrow from. Who's going to help you with this? Your agent can, maybe a family member can refer you to a great lender. Choose a reputable lender with no predatory practices. I mean, you're going to have to do a lot of research on that one. Be sure you can pay back the loan. Yeah, you don't want to get in over your head. Again, you want to be cash rich, a little bit house poor, or the other way around. You could wind up upside down, right? Make sure the payment fits your budget and long-term plans. And this is a tough one around here. Take plenty of time to make your final decision. In this market around here, from Richmond and Oakland and everything in between, things move fast. And there's a lot of competition out there. So that's tough.
So we ended about, I guess, 3 minutes after an hour. We started a couple minutes late. But I do want to just say thanks for being here, and I'm going to hang out for a bit if someone has other questions.
I'm curious, you may have seen my comment earlier. I'm curious just about the car buying process. Like I put in the chat, I was fortunate enough to be gifted a car from my parents, inherited from an older sister. It's not a pretty car, but it's gotten the job done since 2011. So now me and my wife are at that point, about to have a baby and kind of forced to buy a car that will be safe and functional for the family. So
the best person to talk about this, I think he presented this on one of the prior things, is the guy in our office, Paul.
Oh.
He was buying a car. His story is ridiculous. So he was buying, he had the idea for the car, and he contacted, I think it was a Subaru. Was it a Subaru, John?
I think it was a Honda. And he contacted all the Honda dealers, you know, around here up to Sacramento.
50 dealers.
Yeah, something crazy.
Ridiculous numbers of dealers. He called them all and said, I want the best deal on this car. And he just played them against each other. For
he actively pit them against each other. Like, oh.
Saved thousands of dollars, you know. Oh, I got this one over here so I could get it for 40,000. Oh, this one said 35. Oh, this one said 33. This one said...
I bet you all those dealers like still talk about him.
Yeah. Like,
that guy.
They hate him. They hate him.
I have a quick question. So I recently was checking my credit report and I saw that there is something from Comcast, an open account from Comcast on there. And I'm just wondering, what's the best way for me to, it's not from me because I don't have Comcast. So I don't know how it got on there and where it's from, but what's the best way for me to address it? Because it is showing negatively on my credit report.
So it's a great question. You have to call two people. You've got to call the credit bureau and just let them know that it's not you. You have to call Comcast and say, hey, this is showing up on my credit report. And I would treat it as if I would go into it saying, you know, hey, this shows up on my credit report. Can you tell me why? And they're going to go, well, it showed up like from 2010. There's this thing happened and it showed up here. And you can go, okay, 2010, where was I? Did I have Comcast? Did I miss a payment? Did I have a roommate? Was the roommate supposed to pay for that and they forgot? Figure out what it is. And then see if you can't resolve it. If it's a $50 thing, I would pay it and just be done with it. It's the easiest way, is save you a bunch of time and your credit will respond positively. If it's hundreds of dollars with lots of late fees, then I would argue it for sure. I think we can go home for the night.
All right. Thank you. Thanks.
Good night. Good night. Bye.
Good night.